Welcome back to Upticks. I'm Jake Falcon, the founder and CEO of Falcon Wealth Advisors, and I'm joined by my permanent guest, Cory Bittner, who's also the co-founder of Falcon Wealth Advisors and a wealth advisor at our company. So today, Cory, Upticks is the podcast where we decode the data and deliver clarity for investors who expect more. And today, we're diving into about midway through September of 2025. And it's been a week packed with market signals, economic shifts, and a few surprises that could shape our audience's next move. So whether you're a high net worth investor, you're a retiree managing cash flow and income, or you're a Henry, which stands for high income, not rich yet, and you're still building wealth, this episode, that's right, Cory, it's for you. How about that intro?
Strong intro to get us started, Jake. We're rocketing right into it. I like it.
All right, before we get into it though, Cory, before we rocket into it, I do want to have our quick commercial out of the gate here. So thank you to our audience. Our subscriber count continues to grow. Please subscribe to our channel out there on YouTube. It's simply called Upticks on podcasts, Spotify, or Apple iTunes. If you like our show, please give it a thumbs up or a 5-star rating. I think that helps the algorithm get it in front of more people. And for our loyal audience, Cory, I do have a free copy. That's right, FREE, free copy of my best-selling book, Retiring Right, Smart Steps for Exiting Corporate America. If you click the link here in the show notes, you can download your free ebook. You get your free copy of it. And if you have any questions, just email our producer, Luke, at falconwealthadvisors.com, and Luke can point you in the right direction. Also, quick plug for your social media, Cory. Cory is out there on Instagram, Cory Bittner, KC, and I'm out there, Jake_Falcon_CRPC. Follow along if you want more great content out of me and Cory. All right, Cory, you ready to rock it into it?
Now I'm ready.
All right, tongue twisters again. So here we go. Mortgage market moves. So the mortgage rates, Cory, recently just dropped to their lowest levels since October of 2024. And that triggered over a 9% jump in applications, which is the strongest borrower demand we've seen since 2022, believe it or not. So about 3 years. So both for purchases and refinances, they're both surging, and adjustable rate mortgages are back in vogue thanks to their lower initial rates. A 30-year conventional mortgage has dropped down to a little over 6%. So it's like 6.2, and it was 6.24. So I'm not talking that they've plunged back into the fives. You can get a 15-year mortgage in the fives. You can get some ARMs in the fives. So again, they have dropped down. So Cory, first, before I go into why this matters to our audience, do you have an opinion that you want to share?
Yeah, I think if you bought a house in the last 3 years, now is a great time to evaluate if refinancing makes sense for your personal situation.
Yeah, exactly. And that's why this matters. This goes right into it. So lower monthly payments could be a chance to unlock some equity. So if you're a Henry, if you're a high earner, it now be a great potential entry point into real estate if you've been waiting to buy a house. And for high net worth investors, it's a signal that housing demand is heating up again. Now, here's my take. Here's my take on it. So this, like you said, this is a window of opportunity. And if you've been waiting, like you just said, Cory, to refinance or maybe even buy more real estate, get more real estate portfolio, now's the time to at least crunch the numbers. And the key here is that rates don't stick around forever. They go up, they go down. Now, I think a lot of people are hopeful, Cory, that they'll drop even more from here, but we don't know that. You know, I think I bought my house, when I bought my house, Cory, a year and a half ago, something like that, coming up on 2 years.
I think at the beginning of 24 is when you moved.
Yeah. So yeah, year and a half, a little over a year and a half ago. I would think I was at 7.5% at that time.
That's where they were.
Now I did capture this. I was able to refinance probably about 6 months, maybe a year ago, to 6.375 is where I'm at. So for me, I'm not gonna look at doing anything right now because the rate, frankly, isn't low enough to justify the fees that comes with a refinance. So this show is not advice. So the point is, if you can only save though a little bit, you got to be careful. You got to run the break-even analysis because there's fees every time you do this. So you just got to be careful and make sure what is the break-even. And when I say break-even, I mean, do you have to stay in the house 3 years, 5 years, 10 years to make up the fee that it cost you to refinance? So if you're looking at refinancing, just crunch the numbers and just remember, I'm not saying that mortgage brokers are bad, but they are salesmen. So you just got to be careful. Work with your fiduciary wealth advisor to crunch the numbers and help you calculate that break even before you go to the mortgage broker, just to make sure that you're getting the most bang for your buck. Anything else you want to add to that one, Cory?
Yeah, I'll just add, maybe I'm stating the obvious here, Jake, but if you're lowering the interest cost, that's immediate savings to your bottom line, to your cash flow, and to your budget. And, more breathing room in your budget means more cash flow. And what's interesting about this though, Jake, because housing is such a big part of the economy, I just wanted to add this, is that, if people have more breathing room in their budget, that supports consumer spending. So I think it's interesting that interest rates, they matter, of course, for households, but also just for the economy more broadly. If more people have more money in their pocket because they're paying less interest, that can help support consumer spending, which is a good thing.
I agree. It was crazy how low mortgage rates were for so long, which I think there's been hopefully a balance now. That I think the housing market prices went up way too fast, partly because mortgage rates were really low and these real estate agents could help drive up the price. And so now there's a little bit more of a balance, and I don't think rates are high. They're high as in near term, but historically speaking, a 5 or 6% mortgage isn't that bad of a deal.
Right. It's actually the home prices, right, that are higher than the interest
home
rates.
prices is the issue. So if you are out there and you're going to use this as an opportunity to shop for a house, just because rates have dropped a little bit, you should still be negotiating. And I'm a big believer in getting that price lower. The price is more important than the rate because rates change, like I talked about. So negotiate the heck out of that price, get that price down, get that house bought for as cheap as you can. And then as long as you can afford the cash flow and the mortgage, you can worry about the rate later,
Yep.
So good. All right, Cory, what's our next topic?
All right, another tongue twister. Wages wither for women. So new U.S. Census Bureau data shows the gender wage gap widened in 2024 for the second year in a row, with women earning just 81 cents for every dollar earned by men, down from 84 cents in 2022. The disparity is even more severe for African-American women, who earned only 65 cents compared to white men. As mothers exit the workforce at alarming rates, advocates warn the trend signals a deepening crisis for pay equity and family economic stability. What do you think about this, Jake?
Well, here's my opinion. I'm actually listening to a really good podcast about this right now, actually. Not about this specifically, but about this generally. I have a problem with it. But here's my issue. I don't understand why this happens, though. Like, I don't get it. Like, I'm a business owner, right? You're a business owner. And for me, and this is what this podcast is saying, for me, the key is that everyone should have the same opportunity.
Yes.
Now, that doesn't mean that the result will be the same for everyone, but as long as everyone has the same opportunity to make the same amount of money, then that's capitalism, in my opinion. That's what capitalism should be. It's when you start holding people back or giving people things that starts to taint that. But I'm just curious, like, do you think that's because women have babies, Cory, and go on maternity leave, and then when they come back, they're behind their male coworkers? Is that really still a thing?
I think so. I mean, I'm assuming, Jake, that it has to be. I mean, just given the actual data, because I'm obviously, you and I, right? We interview candidates when we hire people. It's about the opportunity. It's about the role. It's not about the person that we're bringing on.
Yeah.
So yes, I think it has to be. I think that has to be.
I think that's horrible about African-American women. 65 cents compared to the white male. I mean, it's bad. This isn't just a social issue, Cory. It's a financial one.
Clearly.
And why this matters is the pay gaps affect retirement savings, household stability, and ultimately your long-term financial plan, your wealth building. Now, I just, but I don't think the answer is easy. I don't blame the employers. I don't think everyone should get paid the same, but I don't think it should matter if you're male or female or black or white or, whatever. But, the deal is, I think this needs to be brought to more business owners' attention. And as advisors, Cory, what we can do is we can help women build resilient financial plans.
Yeah, it's good.
Right? And, because wealth without fairness isn't really wealth. It's socialism.
Agreed.
To me, that's socialism. And that's why I don't like socialism.
Right.
Or communism. And so I think that women need to feel empowered to, if you're going to have a career, this is the problem though. I think a lot of women, you still have these traditional roles where they take care of the children. But what's weird, Cory, is that a lot of people aren't having kids. Not most, but a lot of people aren't having kids. So it's weird to me that this has gotten worse.
I agree.
Because there's more, what do they call dinks? Mm-hmm. Dual income, no kids.
The dinks.
There's far more dinks. And Rachel and I are dinks right now. Doesn't mean we don't want to have a kid, but we're dinks right now. And there's far more couples that are dinks than there were before. So I don't know why this gap is getting worse. Because Can you explain that? The only thing I can think of is a maternity, but now there's paternity leave. Like
Right.
you took time off when you had a kid,
Yep.
which was fine. You didn't take 3 months, but you took some time off.
Right.
But
I
don't
didn't
feel
birth
like
the child for what it's worth, right?
To be fair, that's right. You didn't birth the child.
Totally.
But why do you think it's getting worse?
I don't think it's an easy answer. I don't think I have the answer, but I do think that the fact of the matter is, if women have children and need time to recover from that, I think the maternity leave is a real part of it. I also think, Jake, in a way that I can't really explain, the fact that, the last several years, if we just think about the last 5 years, a lot of people basically just went home for work and stayed home for a while. And we've seen a lot more people come back to work also. But the cost of the cost of healthcare is a meaningful one for people. So that's, I think, part of the reason that we've seen women leaving the workforce, kind of like some of those trends have talked about. So I think there's a lot of moving parts there. I don't think I have the perfect answer to the question, but I think more women are looking at, if there's two people that are working, the cost of childcare is meaningful. And I don't know if employers use that information in a way that they shouldn't. I don't know. I agree with you, though. I don't blame the employers, but I think bringing awareness to the fact that it is an issue is a healthy start.
Now, is it our understanding, Cory, that this census data was not like industry specific? Like, do you think it was just what women make and what men make?
Yeah, I think
it was.
so.
So here's my take on this. So like maybe I still think manual labor jobs probably pay more than desk jobs. Like being a receptionist isn't going to make as much as someone who is perhaps doing construction. So maybe that has something to do with it. Which I think I'm going to be fascinated by this, because I think actually AI is going to replace a lot of maybe even receptionist jobs. Maybe I think AI is going to start to replace non-creative roles, which will force people to get more creative about their jobs, which hopefully will mean they make more money. And so I'm interested to see what this new technology does to pay and roles. But I think maybe some of it has to do. Some of it maybe is a flawed study, and that maybe
Sure.
not as many women work these skilled labor jobs that are. You got to have construction. You got to have utility workers. You got to have, manual labor is still a thing, and those jobs, rightfully so, probably pay more than someone that sits, at a desk all day, because it's just harder.
Yeah.
There's more risk.
Yeah, and Jake, we've talked about it on here, right? The data is not perfect, right? So
Right.
it's not to deny it. It's just to say, my perspective to kind of wrap this up is that it's a reminder that your financial plan should reflect your actual income in your life, not some national average.
Right. And the best thing women can do to close this gap is to check in with their employers and ask for more. How do they level up? Make sure you're not working somewhere with a glass ceiling, because the glass ceiling, that's such an 80s thing, I feel like now. Like
Yeah, we've moved past that.
You should work somewhere where you have a somewhat unlimited income potential, or at least opportunity to progress and advance in your career. And if you don't feel like you have that and you want that, that's when I think you should look at jumping ship and changing
Go
careers.
Find it. Yeah,
Yes.
That's right. Good.
All right, good. All right, Cory, let's move on to the next one. Another tongue. I guess they're just going to be tongue twisters forever. Mining merger. We've got Hightower to thank for this, because they kind of create this content for us. So mining merger mania, Cory.
All right.
So Anglo American just agreed to acquire Teck Resources in a $50 billion deal. That's billion, Cory. One of the biggest mining mergers in over a decade. And the big prize here, Cory, it's copper. That's right, not gold or silver, it's copper, which is essential for electrification, EVs, and a lot of green infrastructure. So let me just explain why this matters, and I'm gonna get your opinion. Why this matters, the copper demand is surging, and this deal could reshape supply chains and create new investment opportunities in commodities and ESG, which is environmental, social, and governance, portfolios that basically have a mission behind them. So this could shift all of that a little bit here. But Cory, what's your take?
I think when companies are writing a $50 billion check, they are signaling long-term conviction in the energy transition that you're talking about, Jake. And I think it's important to watch. Doesn't mean that people need to go and start chasing headline stocks, but it means that paying attention to where capital's where capital is flowing for the long haul is something to think about, something we think about from a portfolio construction standpoint. But yeah, that's a big number. And I think that is signaling long-term conviction.
Yeah, and I think this is another reason why we don't index. We don't use index funds, index products, blah, blah, blah. It's a strategic play. And if you're looking for long-term infrastructure or energy transition themes, copper may be somewhere to look. But again, the good news is we've got Connor Hanlon, who's our portfolio manager. He is aware of all of these as they enter the landscape, and he's looking at that for opportunities in our clients' portfolios, so they don't have to worry about that. In an index, again, you might be in some stale commodity that isn't poised for a tailwind. And so that's my point of why you don't want to index, is that maybe there is opportunity in copper. I'm not saying there is or isn't, like this show is not advice, but my point is you just want to work with a wealth advisor group that has a portfolio manager that's looking at all of these things and looking for opportunities for your portfolio. Now, first and foremost, that portfolio needs to be aligned with your financial plan. That's number one. But maybe there is an opportunity. That's all the point of this is. Again, it's not advice. We're not saying to do or do not. We're just saying that, hey, this is pretty interesting. $50 billion deal is a big deal. It's a really big deal.
Yeah, real quick, I just want to add to this, Jake. I'm sure I know that you saw this, but recently Oracle, the company, reported their earnings, and they're basically expecting these enormous revenues from the cloud, from data centers that are being built. But what's interesting is that I read an anecdote that said that in order for the power demands to happen, that like the company Oracle itself and the data centers that it's going to warehouse, they are going to require twice the energy of the Hoover Dam within the next 5 years.
Crazy.
So that clearly it's just speaking to the theme here, and it's we're living through interesting times. They're always interesting, but
yep. Not good, Cory. What's next?
All right, labor lag. On Tuesday, the Labor Department's annual revisions to non-farm payrolls, the jobs data that we see monthly, revealed 911,000 fewer jobs were created through March of 2025 than initially reported. 911,000. The sharp downward adjustment based on updated census and tax data signals a weaker labor market and raises concerns about the accuracy of employment metrics. The losses were concentrated in leisure, professional services, and retail, with nearly all revisions affecting the private sector. What do you think about this, Jake? You want me to tell you what I think?
Let me hear it. Well, let me go first. So
go ahead.
I'll tell you why this matters. So a weaker labor market could mean slower growth, and it could soften consumer spending, and the Fed could be more cautious with their rate cuts as they do or do not happen. And so that's why it matters. My take, Cory, is it's a wake-up call. It's time to reassess exposure. And another reason, like I just talked about, not to index, and make sure that your portfolio is built for resilience, not just growth. So again, you want to have the yin and the yang, the value and the growth, the dividend, the defensive sectors exposure as well, not just the hot stocks. What's your thoughts?
Yeah, I mean, I think it's a big revision, but we have these revisions every year. I think that markets and the Fed ultimately make decisions based upon this jobs data, so it just makes you question, or it makes me think about what would have happened differently. Not that it really matters, right? If the numbers were more accurate, so it's almost like the scoreboard in the background is a little shaky, which I think can just be it can be frustrating for people to try to analyze where we're at and what it means. But at the end of the day, you covered a lot of this here, Jake, but I think that we just talked about the census data. Again, this is reinforcing it that even the government doesn't have perfect data. And that's why your plan and your portfolio should not hinge on the latest jobs number.
Right. You shouldn't be making changes in your portfolio based on what the Fed says, what the jobs reports are. That's no way to live. You'll just be chasing it. You're going to be chasing it. Yeah,
it will never end.
Yep. All right, good, Cory. The next one here, tariff turmoil. 2 federal courts ruled that many of President Trump's emergency tariffs are illegal. I think we talked about this already, but if the Supreme Court agrees, the U.S. could owe importers up to $1 trillion in refunds. How embarrassing.
$1 trillion?
$1 trillion we could owe. So again,
these numbers keep getting bigger.
This should shake trade policy, impact inflation, and it could ripple. And I talked about this, I think, last week, Cory, that, I think the tariffs renegotiations are a good thing. I just wished Trump would have done it the right way. Right. And now, like I talked about last week, now you've got the Supreme Court involved. So you're wasting people's time. Yeah. And I hope President Trump is watching this episode. Trump, I'm sure he is, right? Hopefully he's
I'm
watching
sure.
Upticks.
This has got to be
Like,
in his morning routine.
I get it. I get that you're trying to make America great, and I appreciate that. However, I'm please asking you to just do it the right way and don't just go out there and start throwing your weight around when you don't even know the ramifications. So now you may end up costing America, and you're certainly wasting a lot of people in Washington's time on this. And that's my issue, is time. So
Time is a precious resource.
that's my take, is that this could be another game changer, and I would expect more volatility in the market, especially at a trade sensitive sectors.
Sure.
And this is why we balance and rebalance and have a diversified portfolio. But again, I don't mind what he's doing as far as trying to get our negotiations back in our favor. But just, you got to be smart, do it the right way.
Yeah.
Anyways,
yeah, and
what do you got?
The tension here, which I think, again, we covered this last week too, is that, tax revenue is under pressure because of the bill that was signed. So the Treasury needs the tariff revenue, right? We know this to be true at this point because this has changed. And I think it's far from resolved. And even if, Jake, that $1 trillion check goes out, I think the lesson for clients, for investors, is just the same. Your financial plan, it needs liquidity and resilience no matter what's going on in Washington, D.C.
Yeah. Yeah.
But I think I think that's a good take you had there, Jake. I like it.
All right, good. What's next?
All right. WhatsApp whistleblower. A former Meta employee filed a lawsuit alleging systemic cybersecurity failures with WhatsApp that could compromise user privacy. The plaintiff claims he faced retaliation after raising concerns with senior leadership, including CEO Mark Zuckerberg. Meta disputes the allegations, citing poor performance and downplaying the plaintiff's role in the company. So let me tell you, Jake, why I think this matters. I think that it matters more from a trust perspective than it does from a portfolio standpoint, because I think, big tech always faces lawsuits, right? I mean, this has been an ongoing deal, but cyber risk is real and privacy matters. And from an investment standpoint, diversification keeps you from being overexposed to one company's headline risk. But I think when it comes to technology, like, trust in and of itself is almost like the currency. People have to trust what, the platforms that they're using. And it's interesting to hear that, this is what's coming out now. The corporation's denying it. We'll see what comes from it. What do you think?
Who do you believe? I mean, these companies get sued all the time. Who was I talking to? I was talking to somebody the other day, and they're like, we're basically get sued constantly.
Yeah. Yeah. I mean, it's true.
I don't feel sorry. Don't get me wrong. I don't feel sorry for Mark Zuckerberg, but do you believe the whistleblower, or do you believe the company? It's hard.
I don't know why the whistleblower would make it up.
Money.
Yeah, that's true. But that's the same reason the company's going to deny it.
Yeah. And you would hope that if the whistleblower is going to blow the whistle, that they've got proof.
Yeah. Yeah.
Otherwise they're just being silly.
Yeah. So, something interesting around this, around Meta specifically, is that there was a whistleblower several years ago that the company ultimately settled with, and they wrote and published a book, Jake, that was released this year, which they were not supposed to do. Basically, like, outside the purview, like part of the non-disclosure, the NDA that was signed, is that they wouldn't do this. But then the person wrote a book and published it anyway.
Wow.
And, yeah. And what's really interesting is that,
what's the name of do you know the name of the book?
Yeah, I actually ordered a copy of it. I just haven't gotten to it yet. It's called Careless People.
Okay. Go ahead.
And what's interesting about it is that the book ultimately could be published, but it was ruled that the author just wasn't allowed to talk about it. So, Jake, you could talk about retiring right because you wrote the book. But that's you also didn't sign a non-disclosure agreement saying that you wouldn't do something like that. But that's what happened. But it's interesting that is something I'm interested to get to that book. And this actually makes me want to bump it higher to the top of my list.
Yeah, and you're right. Cybersecurity is no longer optional; it's foundational. And
correct. That's the
when
world we're in.
And when you're investing in tech or using tech, you need to prioritize companies with strong governance and transparency. Now, again, this is not investment advice, but I'm just saying that's a real thing. That's where we're at. It's just like, I don't know, 100 years ago, if you were going to put money in a bank, you wanted to make sure they had security so they don't get robbed. It's the same thing now. It's just different, right? So
that's right.
50 years ago, I don't know, they started putting in cameras and hiring security guards and getting better safes and the little emergency buttons, like all that stuff, right? So that's what this needs to happen here with these tech companies. And It's interesting. It's unfortunate for both parties that this person felt like they got treated unfairly. And these attorneys just love this stuff, though. They
do.
eat it up. They just love it, suing people, and it shouldn't have to be that way, but that's the way it is. So it's good to hold people accountable. I don't think we ever going to know the truth, though, Cory. That's what's tough about it.
I'm sure we won't. Here's a quick take for you, though, Jake. If you're out there and if you don't like Meta or WhatsApp or Facebook or Instagram, right? It's all Meta. If you don't like the company itself, but you're passively investing in the market, Meta is one of the largest companies in the world. It's one of the largest weights in the S&P 500, and you are actively financing it. If you are blindly, passively investing your money in the market, because that money's flowing to the top, straight to companies like Meta.
Right, Cory. Good. I wonder how we're got to be such in the minority of just dogging on index funds.
Totally. I think, you just look at the last 20 or 30 years, but I think about this all the time, like the byproduct of people saying, forget about active management, just passively invest your money in the market. The biggest companies have continued to get bigger. And it's companies that a lot of people have issues with, like Meta, like Google that we've talked about on here,
Tesla,
Amazon, so on and so forth. People are actively investing in those companies.
And I get it. Like, if you're a do-it-yourselfer, it is very daunting. Like, I don't think a do-it-yourselfer should be buying and selling stocks because it's a full-time job. Like, that's the reason that you want to hire help. Because if you've got a 7-figure portfolio, your mistakes could be 6 figures. And so I think it pays once you get bigger to hire a wealth advisor and, understand that you don't need to follow the herd and you don't need to index. Like, it's so reckless for me to see somebody put $1 million in a few index funds. Like, that's just so reckless to me. Like, I don't know why anyone would do that. And so, but what's scary, Cory? Advisors are doing that every single day with their clients' money.
Right.
And these advisors are supposed to be fiduciaries and are getting paid millions of dollars to just sit back and stick them in index funds, which is so bad.
Right.
So bad.
Yeah. There's no thoughtful analysis around what's actually happening, in my opinion.
They just charge them 1%, throw them in a few index funds and collect their fees. And it's so bad from an investment standpoint. So it's good for putting some light on that today.
Yeah.
Anything you want to add as we land today's episode? Anything personal in your life you want to share? Any tidbits, Rex?
Well, so I challenge myself, Jake, to think about all these things real quick, all the subjects and what sort of connects them all, right? So what connects all these different subjects we talked about? Headlines, they're loud, but most of them aren't going to change your financial plan. What ultimately matters for you, Jake, for me, for anybody watching this is clarity, resilience, and making sure that your financial strategy holds up no matter what the week, no matter what the month, or no matter what the year throws at you.
That's good, Cory. Good takeaway there. And for our audience, if you don't know, at Falcon Wealth Advisors, we actually have an internal book club. And for this month, we're reading Stocks for the Long Run, Cory. That sucker is big. It's
dictionary.
Really big. Yeah, it's like a dictionary. I usually prefer reading, but this one I'm going to listen to. So I bought the audio version. It's 13 hours, but I'm excited to read. I think we've got 12 people in our book club on our team this month. So stay tuned on that. It's a classic. It's one I haven't read yet. It's like fundamental on investing. So if you're an audience and you want to learn more and you want to read along with our book club, check it out. Stocks for the Long Run. Jeremy Siegel wrote it. He's a Wharton professor. Cory and I both have taken a course out at Wharton, so we're big fans of what they teach out there. So I'm excited to listen to it. And if you have any questions or comments or topics that you want us to address on Upticks, please email Luke at falconwealthadvisors.com, and Luke will make sure that we talk about your subject live here on Upticks. With that, that's all the time we have for you today. Thank you again, Cory, as always, for joining me. And thank you all for tuning in. We hope you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website at www.falconwealthadvisors.com and click the Contact Us button if you'd like to meet with Jake and his team.